Okay, let's do a little transaction analysis type problem here. First thing I wanted to let you know is you may want to go in and click this NE to do no effect. Then you can buzz right through the entries once you analyze them. Okay, so I went ahead and did that to save a little bit of time. And then let's start analyzing these transactions. So A says accrued interest income of $15 on a notes receivable. So essentially they've earned this interest, but they haven't yet recorded it or shown that they've earned it. So it's given to you. We would increase our interest receivable, which is an asset. So assets go up by $15. We also increase our revenue, which is an equity account. So our income is going to go up for that transaction. How about B here? It says determine that the allowance for bad debts account balance should be decreased by $3,200 because expense during the year had been overestimated. Okay, so that's a good thing. We need to reduce that. Now the entry we would have made when we created that allowance account or at the when we did that journal entry is we would have debited bad debt expense. So we were increasing our expenses and credited our allowance for doubtful accounts, which is a contra asset, which actually decreases our assets. And the expenses also decrease our net income or our owner's equity. So if we're going to reverse that journal entry, that means we're going to debit our allowance for doubtful accounts and credit our bad debt expense. That's going to have the impact of actually increasing our current assets because allowance for doubtful accounts is a contra asset. It carries a credit balance, which is opposite what a normal asset would carry. And we're also going to increase our bad debt expense by $3,200, which is actually we're decreasing the expense, but that has an impact of increasing our net income. So these are a little bit tricky to analyze that way. Let's look at C. Now we wrote off an accounts receivable of $1,440. So we need to reduce the customer's accounts receivable, which is an asset. And then we are also reducing our allowance for doubtful accounts, which is going to increase our current assets. So those two are going to offset. Our basic accounting equation stays in balance. Current assets equals current liabilities plus owner's equity. Net income is a component of owner's equity and increases that. Okay, so cash received from a customer in full payment of an accounts receivable of $5,000 that was paid within the 2% discount period. A cash allowance account is maintained. Okay, so customer is paying his accounts receivable. So we need to decrease the accounts receivable. So we will credit that by $500. But they're not going to pay us the entire amount, right? They're not going to pay us $500 because they get to take a 2% discount. I believe that will be a $10 discount. So the cash that we're going to receive is only $490. And then our allowances here is actually going to decrease. Sorry, allowance for discounts is going to increase by $10. Let's just go ahead and check my work, make sure I did that correctly. Looks like we're golden. We're ready to continue. Okay, E. Purchased 8 units of a new item of inventory on account at a cost of $40 each. Perpetual inventory is maintained. Okay, so anytime we buy inventory, we're going to debit our inventory or increase our assets, in this case for $40. Inventory goes up. And I would think then our liabilities, since it doesn't say that we paid cash, is also going to increase by $320. That is 8 units times $40 each. Let's look at F. Purchase 17 more units of the above item at $38 each. Perpetual inventory is maintained. Okay, we should have the same entry, 17 times 38. Looks like we don't really have to calculate that. We can just go ahead and use what they have done for us. Now in G, we sold 20 of the items purchased in E and F and recognized the cost of goods sold using the LIFO cost flow assumption. Perpetual inventory is maintained. So under LIFO, the last ones in are the first ones out. So these purchased lastly, 17 units at 38 are going to be the first ones out the door. So that was $646. And then if we sell 20, that means we need 3 of these at 40, which is $120. So 646 plus 120 should be 766. So we need to credit our inventory or reduce our inventory by 766. Okay, now our cost of goods sold is also going to increase, which is an expense, which reduces our net income. Let me just refresh your memory. The perpetual inventory system is a two-part journal entry. So anytime we sell merchandise, we would actually debit cash or accounts receivable and credit our revenue for the sales. And then we have to take that merchandise out of our inventory. So we credit merchandise inventory and debit cost of goods sold, which is an expense, the cost of the merchandise that we sell. All right, let's come back down here to H, paid a 1-year insurance premium of $480 that applied to the next fiscal year. Well, it looks to me like we are going to increase our prepaid insurance. Looks like it doesn't give me that option just yet. And in doing so, we have to pay for that. So we'll credit our cash, which will reduce our current assets, and increase our current asset prepaid insurance at the same time. Lastly, recognized insurance expense related to the preceding policy during the first month of the fiscal year. So we get to reduce our prepaid insurance, which reduces our asset, and we get to increase our insurance expense, which is going to reduce our net income. All right, let me check my work and see how we did here. So far, so good. All right, I hope that helped you out a little bit. Thank you.